Welcome everybody to Startup Grind. If you are not familiar with Startup Grind, it is a global organization designed to connect, educate, and inspire entrepreneurs. My name is Lucas Latour. I am the host for tonight's activities. Tonight is also brought to you by Dickinson Wright, which is a law firm in town. So if you have any legal needs, feel free to hit them up. They're awesome. If you see Alex Brown join here a little bit later, he's the person that you would talk to. And also thank you to AWH, where I work in my day job, for bringing this event to you tonight, where we build custom software products. Tonight's guest is Steve Leckes. Steve Leckes. I barely landed the name, which shouldn't be hard, but it is for me for some reason. But welcome, man. We're really excited to talk to you tonight.
Thanks, Lucas. Thanks for having me.
Yeah. So Steve joins us. He's a co-founder and CEO of Branch Insurance. And Steve, I'm sure we have a lot of questions. There's a bunch of stuff that I want to cover tonight, but I think the first thing that I want to kind of dive into is, so you've got this kind of long background in the insurance world, and I guess you decided to start a company. Why on earth would you want to subject yourself to that kind of experience? What made you want to start a company?
Yeah, Lucas, I hadn't really set out at my beginning to start a company. I was in a space where hyper competitive market, and it seemed to me so obvious that technology was able to reshape how we brought insurance to insurance customers. And it got to a point where I couldn't ignore it. It was more keeping me up than I had set out to just build a company. And really, the original design of Branch was one that was all about making insurance more efficient, more accessible, and to do good, which was my belief of what its original purpose was. So at some point, I couldn't ignore it, and had to go learn how to start a company.
Yeah, and coming from this world, the traditional world of insurance, I think for folks outside of the industry, it can seem, like it's complex. There's a lot of big players, huge companies, and if you've ever had the experience of going and buying new insurance, you might, be a little bit frustrated with it. But I'm just curious from your perspective, having been in that world, what do you take to be sort of some of the I guess issues with traditional insurance?
Yeah, I mean, I think that the biggest difficulty, or maybe the root problem, is that insurance isn't something that should stand on its own. In my view, insurance should be very efficient, because insurance is only required, especially like in the context of insuring your assets or your personal liabilities. These things occur because of something else you did. You took on risk, right? You bought a home, you bought a car, you chose to drive it. You had kids who also might drive it or do. And in that moment, you needed somewhere to transfer that risk, right? I mean, that's the fundamental product itself. And the way insurance works is it's all of us who are pooling these small bits of our resources so that none of us have to bear the weight of that uncertainty coming to bear on us all at once, right? So we share it amongst ourselves. But the way I just said that, pooling small bits so that the unfortunate few of us can take big chunks, that doesn't sound like it should be 50% inefficient, but it is. And like normally you'd think of economic theory being, once the marketplace is competitive, you'd near marginal cost, right? You would near this point of efficiency, and we just haven't gotten close to it. And we've been doing it for 300 years in the United States.
Hmm.
And so the question then became, what could you do differently? And so like if I start with that, Lucas, as like the fundamental problem, you know, if I was none of us, right? None of us who'd ever experienced insurance in its present form, and I showed up and I saw this for the first time. And I had two experiences. One, I went and I bought an iPhone. And when I'm at the Verizon store or wherever I buy it, they're going to offer me insurance, right? Because I don't want to lose this expensive item. And so if something should happen to it, then like I just buy that insurance right there, or I choose not to. But in home and car insurance, we have hundreds of companies that are going to show you TV ads, have their own signs on every corner on all of the properties around America, all of the cities and marketplaces. And all of that cost is borne by all of us, its customers. And it seems like that first method was probably significantly more efficient for the community who is pooling its resources for this ability to transfer away the risk. And so I think, Lucas, like the big original difficulty, and by the way, like the reason that exists is we created a workforce during the westward expansion in the United States, so that the insurance companies of that period, which were all based in Philadelphia, Hartford, Connecticut, or New York, could expand. And we've grown up around that idea. And so much of the expense structure, the cost of creating this product is based in that old legacy. And so, you know, you start to, even in hearing that, you can start to see where technology can allow you to do some things differently.
Yeah, and you're clearly on to something, and you've had the benefit of having the insights of working in the industry for many years, and um, kind of seeing some of these things. And I think before, when you mentioned that, there's these massive players and they're dropping, hundreds of millions of dollars or more into the advertising of the world, and that's something that you guys don't do, right?
It's something that we don't do. You know, from our perspective, we are trying to keep that money in our consumers' hands, in our members' hands. And so we've designed a number of methods to distribute less expensively. And, you know, not because that creates any margin benefit for
Mhm.
us. You know, we pass all the savings back to our clients. And in doing that, we believe that making insurance less expensive is our privilege of growth.
Hmm.
We also make it significantly easier, and in some cases engaging in fun. And you know, that has so much to do with why we made Branch. But Lucas, you know, I say that nothing is absolute, right?
Sure.
One of the fascinating things about building a new financial brand, especially one where you're making a promise to your customers,
Hmm.
right? Buy insurance from Branch, and when you need us, we'll be there. Yes, you've never heard of us, and we don't have 10 years or 100 years of history that you can rely on, and know other people that have said, oh, yeah, I've had a claim with Branch and it was great. And so that trust tax is very real. And so, you know, a TV commercial is actually very helpful
Hmm.
to compete to combating trust as a startup cost, right? It's a lack of scale problem. But you know, it is counter to how we think about making insurance less expensive. But you can, well, I just say nothing is absolute. But we won't be a long-term TV advertising company.
Hmm.
Isn't the
Yeah.
way we've built.
Yeah. And I feel like I should have asked this at the beginning just to make it super clear for everyone, because we know that there's many different like types of insurance and stuff. So for Branch, what is sort of the actual like offering?
Yeah, we make four products today: home insurance, car insurance, renters insurance, and we wrote the first online umbrellas insurance policy when we launched.
Hmm.
We'll continue to add to that, but it's particularly unique and difficult in that it's instant.
Hmm.
We actually don't need to ask any questions of our prospective members except for what's your name and address. And so with that request of potential customers, we then gather data that allows us to fully underwrite those 4 products today.
Yeah, and this is actually the most striking thing, I think, for me. When I went and messed around with the product a little bit, and it really is, you enter your name and your phone number, and you get something out of you get a price, which blew my mind.
Yeah, you know, Lucas, it's funny because most of our marketplace is made up of consumers who own homes and own cars.
Hmm.
Right? That's the largest part of our marketplace.
Hmm.
And there isn't a digital ability to buy and bundle today. And most everyone I'm sure on this Zoom has heard, you should bundle and save your home and car insurance on if anyone watched the Super Bowl. I didn't get to see it, but I'm sure that was at least mentioned. But there's no digital ability to do that today. And part of the reason is we have to gather 300 to 400 pieces of data about you, your home, your cars, the people in your household, your financial history, your geography, and all of that information goes into underwriting the risk. What Branch does is rather than force you to answer all those things, we gather the information and then present you with a price. And every time you see a number, also super unique. Every time you see a number on Branch's website, you can buy that number. There's no more quotes. We've done away with quotes as this wonderfully archaic idea of a moving target as we continue to interrogate you and we try to keep you in the sales funnel by offering you a number that frequently increases the more we get to know you. Not at Branch.
Right. Like some people will measure your every movement and, everything that you're doing and collect all this data and all this stuff, but you are able to offer a simple, like easy thing right up front.
Yeah, we actually, and there's only the upfront. It all happens, the way we talk about it internally is how do we take all of that customer effort and friction and bring it on our side of the mirror. And so in doing that, we give the consumer the ability to tweak whatever they want about their purchase. But even the prices you saw, Lucas, when you were playing with the product, those are based on your existing coverages. And so we try to make it as easy as possible for you to shop. And for us, that allows us to bring you an insurance offer in moments of relevance, right? Back to my original problem statement. If I have to spend hundreds of millions of dollars to make you know I'm here, you ultimately have to pay for that. Right? It's baked into every insurance product, right? People don't necessarily think about it this way, but the TV ads or the agent costs, whatever it may be, are baked into the policy price. And if I can bring you an insurance offer when you're doing something like acquiring a risk, then I can take that acquisition cost out of what you have to pay, and thereby making your product tremendously less expensive and good.
And I think this is super fascinating as a point of differentiation, because when you mention that there's these big players that are spending all this money, one might wonder, well, how on earth do you get to market then?
It's a great question. And pulling on the first part of that thread too, Lucas, the thing that I think is really bad or just definitionally bad is what we've learned as a marketplace is the more I advertise to you, to anyone, the more I can get consumers to shop. And the more I can get you to shop, the more production I can create. And so what happens then is if I can get more people to shop, then I spend more on advertising and my customers pay for it. And so what we've created is a long-term cycle of churning more of our customers' cash.
Hmm.
And who are the long-term winners of that? Well, I mean, TV networks, Google and Facebook do very well. I think cheap car insurance is one of the most expensive AdWords you can buy. And so like that's actually a good way to think about the problem to solve. And so how do you get yourself known in a market that's this crowded? And one of the early problems we had is if you were cheaper, but everyone is advertising switch and save, or people who switched saved $654, then no one can hear you through the noise. And that is true. I mean, it's a real problem. But for Branch, the way that we make people aware of us is frequently through partnerships, distribution partnerships where our industry in insurance has worked with many other industries for decades or much longer because insurance caused friction,
Hmm.
right? I mean, if anyone here has bought a home, that as you apply for a federally backed home loan, right, your mortgage, they'll ask you for your 1040s, your W-2s, your proof of home insurance. And then it's your job to go out and find home insurance and then print out a copy and take it to closing or email it to your loan underwriter, and they'll recalculate what they can lend to you. And all this describes friction. And so you'll find Branch inside of mortgage lenders' flows. As you're trying to close on a home, they'll present that you could get insurance through Branch. Totally up to you. And if you click through, you could be insured in less than 30 seconds and proceed with low-cost insurance of wonderful quality that also enabled you to get through a much more complex transaction, the transaction that caused you to need insurance in the first place. We were recently in the press, joint press with ADT. This is very similar, right? You're changing your risk profile. And for decades, the home security industry has marketed, hey, it doesn't actually cost you as much as home security as the bill you'll pay because you'll get discounts in your home insurance. But that means that you have to print off a certificate, take it to your insurance agent or company, and then they'll apply a discount. And then next year, they'll ask you to go get a new certificate and prove that you still have home security, which has caused all kinds of difficulty in our math in determining how much the discounts should be. Because what if you canceled your home security subscription right after you gave the certificate to your insurance company? Or what if you didn't know to give your insurance company your certificate? And so by integrating these things, the consumer can get this massive new value in price and convenience because of when the offer showed up in a right moment, and ease because Branch is the only instant auto or home insurance company, and instant in that it can allow you to bundle and save just as quickly.
So, in order to achieve all of this, I imagine you have to have some kind of technology involved. To what extent do you consider Branch a tech company?
Yeah, it's a great question. I mean, I think we consider ourselves a tech company. We also consider ourselves an insurance company,
Hmm.
but we don't think of those as two separate things. The thing that we do is inherently technological, and insurance as an industry has been very data oriented for a very long time. Out of necessity, right? 200 years ago, we'd have a big fire and most of the insurance industry would go out of business. It turned out it was useful to gather a lot of data to ensure you were collecting enough of that pooled money to cover the big losses. But branch is much more fundamentally technological. My co-founder and our CTO, Joe Emison, I think this is his 6th startup, and wonderful serverless architecture. I think you can actually find how to build a serverless insurance company video on YouTube or out on the web. And so highly technological in nature, very contemporary, progressive style of technology. And the thing that makes us most uniquely different is a combination of reimagining the method of underwriting insurance and then using software to acquire data in a very unique way. And so everything is built from that that seed, which was in answer to the how can you make insurance less expensive for consumers. So very, very tech oriented. I think of our earliest staff when it was just me and Joe. It was me and Joe, and then 5 developers, or a designer and 4 developers. And so, from the beginning, it's been very much about technological separation from the marketplace.
Is the big piece technologically? Is it sort of is the effort in integrating with all of these different things, or what kind of ways is technology leveraged in the product?
Yeah, I'll give you a couple of examples. One is in the algorithmic assessment and acquisition of data. And the way that we do it is we use your name and address to gather more information. We use that information to gather information we couldn't gather with just name and address. We use that information to gather further information, and then we cycle it back recursively, filling in the gaps and holes we might have had. The second aspect is we were built API first, right? If the big idea is transforming the market so that the product can be very efficient, right? And if you thought of if you thought of all of insurance as home and car insurance, I'll describe it as 50% paying claims, 10% the cost of adjusting claims. General expenses like real estate and everything else at scale as 5%. Profit as about 5%. And the balance being acquisition cost, marketing and agency commissions. Then the way we think about direct to consumer insurance would be like your Geico's or your Progressive Direct or Esurance before it was recently rebranded. And so in that model, you got to take out about 15% of the acquisition cost because you just did direct marketing. And so in our model, you can take out the rest of the acquisition cost in some cases. And this makes this smaller and smaller cost of creation passed back to consumers as the benefit of less expensive insurance. And we built this business API first, right, to allow us to do that. And so you can find branch embedded in places through APIs and really unique and simplified UX. And that's probably the most tangible and obvious technological innovation. But on top of it, I'll give you a third example. Sorry, I said 2.
No, you're good.
But we, through our app, our members can actually self-identify as non-fraud, right? Insurance fraud costs all of us every year tremendous sums. We estimated it somewhere between 10 and 20% of all premiums paid to insurance companies end up being paid out as fraudulent claims. And so in that amount of money, which is tremendous, right? We're in the US, I think we're something like just P&C insurance is about let me see if I get this right, about $500 billion a year in premiums. That 10 to 20% is fraud. And so we allow our members to say, Lucas can say through our app, Steve, I'm not going to defraud the company. I am someone who's like responsible and trustworthy. And so don't charge me as much. And what we allow you to do then is expose that pledge to other members that we share a contact with. So if they're also branch members and it's someone that you can ask them to vouch for you. And if Natalie and Yolanda vouch for you, your price of insurance will also decrease, right? All through the app, entirely technological in nature, allow you to use your social network in real time to, basically continue to confine the group of people that could have fraud within it.
That's super interesting. So essentially, people in your network vouch for you and say that you're not fraudulent, and then you get a discount, right?
That's correct.
That's super interesting. There's some other companies that kind of do that. Like, I'm curious how you came up with this model overall. Like, when did this start to percolate, and how did you kind of come up with the model?
Yeah, I I grew up at a really big insurance company. I learned a tremendous amount there about the economics of insurance, the business of insurance. I then had the cool opportunity to build the first online home insurance business in the US. And then I left insurance proper and went to the largest seller of data and predictive analytics to the insurance industry for underwriting purposes.
Hmm.
And then along the way, I became obsessed with the question of how did big insurance companies become big? And it turns out it's really hard to answer some of the older questions about insurance because no one writes it down, because no one would publish it, because no one would buy it, right? Only I would read it. Maybe
Steve's in there reading it.
Yeah, so I'm there reading it, and the combination of these experiences, watching the direct models grow rapidly while the agency model was slowly shrinking, and that's a very general statement. And then having a chance to build in both an agency business, but then also pioneer a direct-to-consumer market. And then when I saw the economics of data and I learned so much more about where data was, what types, and how to acquire it. And then I found that there was only one historical theme of how to scale a big personal insurance company. And that was, and this story holds true for every big brand when they won their market share, that period was perfectly bookended by when they had a lower cost for like coverage for a large portion of the population. I maintain that the greatest innovation in the last 100 years in our market was a guy named George Marhurl who founded State Farm. And at the time, 1922, fully a third of the US population were farmers. And he found that farmers shouldn't have to pay as much as city dwellers. Which isn't totally surprising. There were a lot of people living in cities. There were no streetlights and no regulation at that time. And so you can imagine how many more accidents would have happened. That great idea spawned State Farm, Nationwide, Farmers, Country Financial, all the Farm Bureau insurers. Amazing diaspora. And so as I learned that this method had always persisted, then I saw the combination of these four things come together. And I was faced with I felt like I had a recipe and was faced with the question of, well, if you had this data and technology, how would you use it to make insurance less expensive? I also believe very strongly in the good that insurance is meant to do. And not that it always has. I actually keep my own little folder of all my insurance history of terrible things our industry has done to humanity. And it's not a thin folder. But that doesn't mean that that's what it was intended to do. And so we at Branch talk about, we're not trying to disrupt. We're not trying to reinvent. We're trying to restore insurance to its original intent of force for communal good. And it became really obvious as we worked through how you would fully leverage this differentiation because we have a lot of differentiation. First umbrella, first instant, first ability to digitally bundle, first ability to fully embed, first community oriented discounting structures. But how would you bring it to bear so that consumers could gain the most value, and that you could be in a less competitive part of the biggest part of the market, which is a really difficult thing to do. And so I had a lot of ideas. And when Joe signed on, we got to the hard work of downscoping and then raising money. And we brought Branch to market essentially as you see it today.
You mentioned raising money, and this is one of the stories that's really interesting about this company. Is I think recently you've raised like $24 million as an A round. For people who are thinking about starting a company, what is that experience like? How do you start to think about, you know, raising money and like how much to raise and that sort of stuff?
Yeah, Lucas, that's such a good question. I mean, I think, at least I'll tell you our story. Our story was one where we're building in a highly regulated market.
Hmm.
It makes MVP very difficult in its traditional sense. You have to check nearly all the boxes of the full product to be approved to do anything in
Hmm.
market, right? And for good reason, right? Consumers are putting their trust in you,
Hmm.
right? You have to have many millions of dollars sitting idle in the bank if you're going to bear the risk, right? These are
Hmm.
important regulations.
Hmm.
And so I think the best advice, and I, having spent a lot of time working through it, especially having never raised money
Hmm.
before we started Branch, that our Series A was our second round,
Hmm.
is you should raise only what you need.
Hmm.
And maybe a first question is, what am I trying to achieve?
Hmm.
And I think, for us, I we have built at Branch a capability that can take this market, right? It would require a lot of good things continuing to happen for us, but this is a $400 billion market, just this home auto umbrella space, and going after a huge market allows you to think about venture capital as a fundraising source. Having a really strong team also helps, but we weren't really in this for a lifestyle business. I mean,
Hmm.
many of our leadership team, Joe and I especially, gave up a lot higher paying jobs to take the risk. And and so, we were going to try to make an impact. We were going to try to do something that hadn't been done that could be really special. And in that, you know, getting to scale as quickly as possible is of huge benefit if you want to have a shot at winning. And so all of that was in our calculus as we thought about how much to raise. But Lucas, I'll also tell you, fundraising is a skill set, one that I did
Hmm.
not possess when we started. We got a lot of no's. Um,
Interesting.
it's actually quite normal. So if anyone's thinking about this or going through it, don't give up. I've heard the adage, you pitch 100 to find 10 interested to find your lead. And I don't think that's totally untrue. I think we had probably pitched about 70, and we got a lot of geography problems. Like, we only invest in New York, we only invest in San Francisco. That can also just be a nice way of saying, like, that's not really us. We
Hmm.
also, we're pitching people that we didn't know well enough would never have said yes, right? There were Series B funds, and we were pitching
Hmm.
a seed, right? And by the way, like, the seed, in my experience, I don't know if this is true for everyone, but the seed's so much harder than the A.
Hmm.
And I presume the A is that much harder than the B. because you're selling a story. It's just an
Hmm.
idea potentially. When we raised our seed, it was for us. And,
Hmm.
the story is so important, especially if you're raising venture capital, because everyone's investing in a future. Everyone's looking for proof points or an alignment with a thesis, right? Or an idea that they believe can work, uh, that's told by a team that's inspiring and that is credible. And so, like, there are companies who are masterful fundraisers, and they don't actually, they don't need to have as good a business because they're so good at fundraising, right? And
Hmm.
you can think about your skill in fundraising as a big part of your cost of capital. Uh, and so, there's all kinds of different advice for how much you should raise and how you should think about dilution, or should you, or what do you need to get through? I think every scenario is pretty different. And, happy to give more specific advice if there's anybody working through that now or offline.
By the way, folks, feel free to keep throwing questions in the chat because here in a few minutes we will open it up for a few questions. But so one of the things you mentioned is geography, and I think when we talked before, you had mentioned that you specifically picked Columbus as a place to launch this business. Um, Talk us through like why Columbus out of all the places that you could have gone.
Yeah, Lucas, I think the easiest thing to do with as many variables as you have already at startup is to start up where you are, right? You've got whatever infrastructure you've built because your life is there. For us, and ironically, in the pandemic, we've kind of flipped on this. But Joe and I had originally wanted to co-locate, right? We felt that it was important that we work together, working through all the difficult things that you had to work through. And so he was living in Asheville, North Carolina, and I was out in Cleveland, Ohio. But I was working out of Jersey City, New Jersey, and commuting. And so we knew one or both of us was going to have to move. And so we took it as an opportunity to say, well, if one or both of us has to move, then where's the right place to locate branch? And we were thinking very long term about how we made this decision. And so we started by gathering information about every metropolitan area in the United States that had more than 150,000 population, which was 208 cities. We then developed a criteria set. I think it was 12 points. And I think we pulled about 83 fields of data, which we got pretty well for every city in every of those 208 cities. And we were able to narrow it based on what we thought was important to the company. And like, as an example of what would be important for us in a hyper competitive insurance market, and us trying to make insurance less expensive. That's actually our mission. We make insurance less expensive so more people can be included and insured. And so one of our highest ranking criteria was the cost of living, which naturally took San Francisco, New York right out of it, even
Hmm.
as the venture market was saying, no, we prefer you're within arm's reach.
Hmm.
Um, and they do that, so that they can support you, but it would be damaging in the ultimate price we put through to consumers, because the cost of creating the product is a huge part of what you charge. And so we narrowed it algorithmically to 21 markets. And then this was a really interesting exercise. We socialized that 21 with a number of recruiting agencies we knew well, and with about 20 executives, many of whom were advisors and friends, and some of whom we wanted to hire. And we asked them, of these 21 cities, like, just tell me, yeah, I'd consider moving there, or no, or absolutely would move there.
Hmm.
And some of the top 21 got 100% no, wouldn't
Interesting.
consider it. We even got a hell no to one of the cities from an executive.
Wow.
Yeah, and then there were a couple cities that got all yeses. Um, Austin, Texas, and Nashville.
Mm,
Interestingly,
mm,
we ended up narrowing the list down to four, which
mm.
were Columbus, Nashville, Austin, and Raleigh, Durham. And we visited each, spent time with the economic development teams, as well as got to know the space. Joe Esri plotted a number of different life kind of personas. People with kids looking for good schools, people who wanted to live downtown. How easy would it be to have a good quality of life in these towns? And ultimately, we chose Columbus. And Columbus had a couple of really great things about it. And I grew up outside of Akron,
Mm.
lived in Chicago and San Francisco, worked on out of the East Coast. And so, I think you always kind of discount the place that you're from, like Ohio, really the best place. But what we found is Columbus it met all of our criteria. Things like big university, the types of talents that were local, how well we could recruit. But it had a bunch of things we hadn't anticipated. One of my favorites was it had a long-term wage inflation outpacing expense inflation.
That's
This
interesting.
this is really interesting too, because like I grew up in the Rust Belt, which had kind of the exact opposite, and Cincy, a very opposite trajectory as well. And so Columbus, right between the two, kind of infrastructure built in the post-industrial age. We complain about traffic here, but there's no traffic here. You can get downtown in 25 minutes if you live 25 miles from downtown. I mean, it's really amazing. Some of the other cities we talked about have real traffic issues. Aren't a lot of good places to live downtown without that most people could afford. And we've been very right. I mean, I feel like we made a great decision. The state of Ohio has been very supportive through the Jobs Ohio program, the Columbus Chamber of Commerce, economic development teams. Everybody's been kind, gracious, and looking to be helpful. And I think, Lucas, you had said to me, we were talking before, that it wasn't that long ago that the startup scene was a lot thinner here.
Sure.
But that was something we really looked at when we considered the town. Like, was there enough infrastructure here that people could even know what to do with us? Because as a lot of you know, as a startup, you're underwritten twice, right? I mean, like, we're highly data oriented. And we had some of our early data partners who I've known for a long time send people out to our office to inspect that we had, a deadbolt on the door, right? Which they never do to us in our current stage, but at our very beginning, absolutely did. And so, like, it's useful if the people around you understand how to support startups.
Mm.
And Columbus has been great.
Yeah. Well, that's great to hear. And I think for anybody who is thinking about recruiting companies to Columbus, that's a really good story and an interesting way of approaching evaluating different cities that I think maybe could be replicated for other companies that are trying to decide where to locate themselves, because we have a couple other companies that are recent transplants as well. So I think hopefully that's a trend that keeps going, and maybe people can use that as well. um, so I'm curious about, a little bit about the journey too, because, you know, I think you said you're, what is it, year two in business? Is that right?
We're actually have been in market now for about 18 months.
Okay, 18 months. And the company didn't start 18 months ago, right? Like in terms of your effort on it. Like when did you actually start working on the idea?
Yeah. Well, I suppose I'll answer it three times.
Okay.
Um, we, I quit my job in February of 18
Hmm.
and went full time on branch. we incorporated the third to last day of 2017 as we are just getting ready, to officially start up.
Mm,
And then it was early 2016 that I knew I had to do it. Might have even been late 2015. And at that point, the biggest problem to solve was, how do you fund it?
mm,
Just having grown up in big companies
mm.
with no sense of how to fund it, and maybe more importantly, no network in capital.
Yeah, I mean, you mentioned the seed round being a bit harder than the A round, or maybe way harder. I guess, like, how did you kind of figure this out early on? Because that is a big problem, and a lot of people don't have a clue where to start with that. And you think, well, I've got this amazing idea, but it needs a bunch of money behind it to help it grow and flourish, and to build a product and all that. So, I mean, talk us through that a little bit.
Yeah, I think when we first started pitching, um, to me it was like, here's the recipe, right?
Mm,
We're gonna go do this, and it was, I mean, we already had like a to the penny financial projections of 5 years. Like, we'd worked through an insane amount of detail, all of which you end up proving wrong, but the planning had all been done. And so, I anticipated um, that we would go out and tell a story, and those that could believe might want to invest. But I think the big uphills I found were, a lot of investors didn't really understand insurance.
mm,
There was also a perspective of, well, it's too regulated. Like,
mm,
you can't really innovate there.
mm,
Uh, and um, and that was also a proxy for a lack of understanding, right? How would you do it? Do you need to raise $500 million because you're going to need to build a brand, right? This is how everyone would do it if you're going to go D2C in a competitive marketplace. And so there were a lot of questions that weren't answered in our original storyline.
mm,
And I mentioned it earlier, but so much of fundraising when you're early is telling an inspirational story.
mm,
And I think our story was way too analytical, right? There wasn't enough heart in it. And I say heart, just there wasn't enough heart capturing in it.
mm,
And so, the seed round from that perspective also, like, we had families.
mm.
When I quit my job, my wife was pregnant with our third. Uh,
Wow.
and uh, and I had a full-time job that was very demanding, right? I was working 10, 12 hours a day already. And so all these things make it very difficult, if you've got liabilities. This is why a person might say, man, I wish I would have started a company when I was much younger. But for me,
Mm,
this was the right time because I had to amass these experiences. And then, some of the actual things that happened in fundraising is the very first fund I pitched. They said, this is like a tech play. Like, the way you're doing this is all about tech, and you're going to be a lot more credible with a technical co-founder. And I loved that idea. I didn't, my first pitch, wasn't with Joe yet. But having a co-founder, especially one that you can trust, who's brilliant, in my case, probably smarter than me, which is a good recipe,
mm,
that you can do this for a long time, and argue and debate and optimize. uh, it's, starting up is very lonely. You're out doing really hard things. The rejection is plentiful, like constant. You've got to be able to sell all the time, right? Every type of counterparty, investor, customer, like, you're always explaining your story to someone. And that's like such a huge part of the fundraising story. And then I think our Series A was significantly more fun because we had, as hyper analytical as we are, and all of that planning we had put in, when we got to the A, we had been nurturing a group of potential investors for the A, and we delivered on all the things we said we would, right? And so now you have this added boost to credibility as your story and skill set becomes better at fundraising generally. But, and you kind of said it, Lucas, we raised at probably the absolute worst time
Mm.
that anyone could raise. We had started road shows on February 29th in DC. Then the next week was San Francisco, Philadelphia, up and down Sand Hill Road. And then we flew the next week to Boston and Greenwich and New York. And by Thursday, which I think was the 12th of March, the last of our in-person meetings turned into Zoom, and we flew home early. And the difficulty about fundraising, a difficulty, is you want to fundraise as late as possible on
Mm.
how much money you have,
Mm.
because you want to prove as much as possible, right? That's the natural inclination, because you're going to be assessed in some ways off of the proof you've created. But you don't want to run out of money. Like, this is the most important thing, right?
Right.
And so for us, we had, judged it like anyone, has to make this judgment call. And then we had this moment of, the whole world is uncertain on whether the sky is falling or not. Like, what will it mean? And there was a tremendous expectation of a huge recessionary period, right? People had been predicting it already, and COVID was going to be the catalyst. And on top of it, in the capital markets, most of ventures money is going to be made up of other people's money, right? Their LPs. And so if an LP has dedicated some money to venture capital, it's a higher risk asset class. And so now, if all of a sudden the stock market has taken a hit, then that's immediately marked, right, in your portfolio, because the market is known, the trading value of that commodity. But in your venture portfolio, like, you won't actually know how to mark to market for a long time, right? You wouldn't make a big change off of last valuations. And so that meant that all of a sudden everyone was over-indexed in higher risk asset classes relative to what they had said I'd like my portfolio to be. And so we saw a lot of venture capital outfits who weren't sure what their future would look like,
Mm.
and we're deploying less capital for a period. Fortunately, that let up pretty quickly. I mean,
Mm.
not so quickly, but I'd say by June, it felt like, the market had become stronger again, not as strong as it had been. And then in InsurTech, we had some companies in our space start to IPO. The very first was, I think, June or July.
Mm.
And so, like, we raised right in between those two marks, which was the beginning of shelter in place and the first IPOs. I say probably the worst timing, but we had a phenomenal fundraise, brought in some really stellar investors who have been incredibly helpful to us, not just in our thinking, not just in capital, in introductions, in opening their networks to us. And it was wonderful. Can't say enough good things about the investors that we have at Branch. But yeah, it was, there was at least a little bit of a scary moment there, Lucas, if I'm not being totally vulnerable as I say it.
No, that's great. Yeah.
That can be hard.
That's an incredible story, and I think speaks a bit to the resilience of you and the company. And a lot of us have had challenges, and some much worse in 2020. But that is pretty wild timing to have gone through that and to come out on the other side and seeing the light of day, and now you know looking forward to actually growing and scaling. It's pretty incredible.
Yeah, thank you.
Yeah. So, all right, I want to turn to some questions here. So one question from Nikhil is, uh, given the knowledge that you've already had, how has that affected like the path of iteration to product market fit? Were you able to get product market fit quicker because of like your previous experience, or was there any like baggage that you had to kind of wade through from like previous companies?
Oh yeah, I mean, and thanks, Nikhil. I think there's a tremendous amount of deprogramming
Mm,
that starting up causes you to face. And it's important to be conscious about recognizing it. That one of the principles that we hold internally is called Ask Why, and it's really very much about this. That there is, there are no sacred cows. The description of our Ask Why is, the intern should challenge the CEO and ask why, and there should be a thoughtful rationale, and that's been helpful. People here live it, and we've absolutely had those things come up. As an example, one of my favorites is um, our industry in home insurance will frequently not take you if you have a set of one of a dozen breeds of dogs.
hmm.
We don't actually have any good data to support this in eligibility. The reason it exists is because dog bites are frequently very expensive claims.
Mm,
And so I colloquially describe the way that underwriting eligibility evolve as someone had a terrible claim, and then the claims manager gets called on the carpet in front of the executive team, who like bang on the table, why are you paying this claim? And he points at underwriting, and then we're like, why did you let this person buy insurance? And it's like, well, we didn't know. And then we just write this rule that says, okay, no one that looks like that can ever come in here again. And like, this is the exact opposite of data, a data driven decision. And so we've eliminated many of those constructs at branch and instead allow people to create data, or we create data that allows us to better underwrite. And ultimately, we create a price for everything. There's no point in turning people away. You should understand the risk, because it is, everyone's risk is going to come out of everyone else's pooled money, right? So it doesn't do anyone any good for me to come in as a very high risk individual and pay the same, Lucas, as you, who would be a very low risk individual. It's not the right stewardship of the cash. But we have had to think very differently about a lot of the baggage that we've brought. And we love hiring people who are really deep in their knowledge and expertise, right? Whether it's insurance or customer acquisition or whatever. But we ask everybody to think about explaining why the things they do work, or why the things they do should be done again. And the thing we love about it is, if you've had a chance to do something and you have learned from it, you've observed it as it's occurred, you usually have an idea of, man, if I got a chance to do this again, I'd do it differently.
hmm.
And we've brought a team together who has a lot of those. Here's how we could do it better. And branch is made up of being inches better in every way we can find than the places we'd all worked and experienced before. Nikhil, did I catch all your question?
I think he's still listening
Yes,
in,
sir.
but
Yeah, I
oh,
was listening. Yes, sir. You did. Thank you. I appreciate the detail that you went through, uh, because how messy insurance seems, just in terms of everybody needs one and then nobody wants to deal with it. Like, let me, as a consumer, I was like, I don't want to deal with it, but I need it. So I can only understand how vigorous and rigorous the business internally is. And somebody coming out of that business to say, now I'm going to be a startup guy and a sort of a tech driven startup. Well, what did you have to like let go, and without losing the core business that made sense? And so I appreciate you spending that time and cycle to help me think through
Yeah,
the
thank you.
process.
Yeah, and Nikhil's also an entrepreneur, so it's cool to have your input here, Nikhil. So one other question is kind of a quick, simple one: is why the name Branch? Is there any special significance to the name?
Yeah, there is. I never thought the name would stick, but when I was penning all this out in sleepless nights, I named the idea, the project, after my favorite part of insurance history. And my focus was always U.S. insurance, but the very first underwriting eligibility in the U.S., as far as I could find, underwriting eligibility just meaning wouldn't accept you into the company. Didn't think we had a price for you, didn't think you were a good risk in that old idea, was all about trees. And so there was a company in Philadelphia called the Philadelphia Contribution Ship. Actually, I think the full name of it was the Philadelphia Contribution Ship for Protection of Homes by Fire. They were great
Wow,
marketeers.
it's a mouthful.
But that company determined that homes that had shade trees or trees in close proximity to the structure were much more likely to burn. And they decided then they wouldn't accept anyone else with trees. This may have been linked, Ben Franklin was on the board, and he also, about the same time period, was creating the first fire department in the US, the first fire brigade. And so maybe there's a linkage there. I'm not certain, but some of the employees quit and they formed the Mutual Assurance Company for Protection of Homes by Fire. And at the Mutual Assurance Company, which became known, if you guys have ever seen these old fire marks, they're called, they're cast iron, and it would be the mark of your insurance company, kind of like you see like a home security sign out front. Like these were hung on people's front of their homes so that it was known they were insured. And the Mutual Assurance Company was just a big plumed tree. And so they became known as the Green Tree Mutual. And what the Green Tree Mutual did is they created a bifurcated price, the first price segmentation in the US, where you'd pay X for no trees and you'd pay Y for with trees. And I loved that story. I also loved that branches created cover, right? There was a lot of metaphorical significance, and some of the early ideas I had about bringing back the old idea of insurance as a communal product, right? There is actually no such thing as an insurance product of one, right? We sell a product that is pooled resources. It has to be, otherwise it's a savings account, and it probably won't, solve the full problem the way most savings accounts are. And so in that idea, Branch was a really fitting name. And we went through a lot of early brand work. Branch always stuck, so it'll always be close to my heart for that reason. But named after, insurance roots.
That's a really cool story. So you're saying you didn't just go to createmylogo.com and just randomly generate something.
No, but I think our original logo, I think we only paid someone like $5 to make.
What?
So this is not this one. So there was that time.
That's the bootstrap. That's the startup hustle. That's awesome. So I'm curious about the community aspect of it. I think that's one of the things that it's definitely worth mentioning before, and not just the like the non-fraud kind of thing, but sort of talk about how you're addressing the problem of underinsurance.
Yeah, I mean, in the United States, there's about 30 million people who are drive without insurance,
Hmm.
right? And that's illegal in every state but one. Um, and it's not that they don't want to have insurance, they largely can't afford it.
Hmm.
And part of how we make insurance reinforces some of those exclusionary constructs that exist in the marketplace, like financial exclusion frequently exists. As insurance, as that's what we do, that's so core to our identity, we believed this was bad. And we believed insurance should be good. And so if we were going to attack any problem charitably, which was always something that we had close to who we were and to our hearts, we built a foundation. We call it Safety Nest. It's a 501c3 nonprofit. And of all payments we take from customers, we slowly fund this organization that's intended to combat that financial exclusion problem. You can check out a little bit of the story on safetynest.ourbranch.com. But if you thought of this vicious cycle of what it's like to have no insurance, if you're driving without insurance and you're going to have a difficult time registering your car. If you're driving without insurance and you get pulled over, you'll be cited. And frequently, there will be significant fines, usually, as much or more than your insurance would have cost. And in some cases, and unimaginably, you'll end up jailed for it. And I actually think I saw one of the participants. There is another insurance startup called Vanzella that's trying to combat uh, some of the bail problem for
Yeah.
people that are incarcerated without being guilty. And Judd, who I think might be on the line, sharing some data with me around people who get put in jail because they don't have insurance. Now imagine, like, aside from being jailed or fined, imagine that you actually get in an accident. Like, this financially excluded group frequently correlates with people that are much close to or below the poverty line, right? I just said that it's not they don't value it. It's not that they don't want to be inside of the legal requirements, that they can't afford it and they have to make hard life decisions around where the money goes. And so now like, you were already just trying to get out of poverty or out of into a better place, right? And so we think about insurance as being the thing that allows all of us to stay on our positive life's trajectory without falling off because of the uncertain things that can and frequently do happen in life. But for this group, they don't get to be a part of that wonderful risk transfer that the insured population does. And so we think of Branch as making insurance less expensive. We are driving the cost of creation down, passing those savings back to consumers, which is good. And our members love us for it. But that by itself doesn't include the excluded.
Mm.
And Safety Nest may have the harder uphill, which is to pull those people back into the included population. And we've been experimenting, right? Nikhil's question about product market fit, way more pronounced for Safety Nest. And so our original generation of this was, we were giving out grants to people who had that terrible thing happen to them and were really good people with horrific stories, and we were able to help them put them back on their positive life's trajectory. But one of the challenges was finding those people.
Yeah.
Right? They didn't know Safety Nest existed, and we couldn't find them. And so we continue to iterate, and we continue to fund research around this financial exclusion problem. But this tandem of Branch creating less expensive, more affordable insurance, more accessible insurance, and Safety Nest trying to solve this problem. We've started with car insurance because it's so quantifiable and obvious. But it's not, Safety Nest is not limited to car insurance. Uninsurance And you'd be amazed, the insurance industry gives tremendously to charitable causes. We just think that it doesn't make a lot of sense for us to focus on every charity that isn't the one that we were designed to do good for humanity. This is the thing that we can do. And so, yeah, it's a part of how we go to work every day is to solve that problem.
Well, that's incredible, and your story is phenomenal, and we're really lucky to have you here in Columbus making a difference. And we all hope that Branch continues to grow, and I'm sure it definitely will. So thank you so much for coming and sharing your story. We're really lucky to hear from you and other great leaders. So folks, we'll give them a quick round of applause. Thank you, Steve. And folks, just before we go, I should mention we are having a founder forum virtual happy hour March 2nd at 6 p.m. So if you like this kind of stuff, if you want to meet other founders and talk and share stories and talk shop, come out to Founders Forum, and we would love to have you. But thanks everybody. This has been a great startup grind, and we will see you all next time.